one thing caught my eye in your earnings release, and that is the kind of churn or attrition you've seen in your mortgage portfolio. And it just, sort of the question popped in my head, simple maybe, but this, in a very low interest rate scenario, do NBFCs still have an incredible competitive edge?
That's a good question, and that's why the answer to that is, what is the differentiation that an NBFC brings to a particular line of business versus a bank? If it's only going to be interest rate arbitrage, then when banks get into those lines of business, it will get really tough for an NBFC. Now look at it this way: HDFC Limited is an NBFC, but it is the largest home financier competing with banks since inception. So it's not that you can't build that differentiation, but there are enough NBFCs that don't focus on building the differentiation, that don't focus on that customer service, they don't focus on the uniqueness of their product or service. And they are the ones that will get hit, because as is obvious in the last few months, banks are not able to extend credit to most of the other lines of business. So as a result, they're going after some of the retail lines, and they're able to cut rates more than most other NBFCs.
So you've had to take, or you said you will be taking competitive pricing action. So it's a race to the bottom right now.
No, not really. In our case, in none of our lines of business are we the lowest interest rate service provider. But it does not mean that you don't stay within the range of interest rates at which a good quality customer will come to you. Otherwise, you'll get adverse selection. So when we see rates falling, we will also cut we'll also partly cut our rate. But on the other hand, there are a lot more intelligent things that you can do to ensure that your book still stays not only of good quality and reasonably growing, but profitable as well. And I can't let out all those secrets.
All right. Bad loans, GNPA or gross national NPA ratio would have been 2.86. This is the pro forma numbers if the Supreme Court stay had been lifted, versus 1.34 in the preceding quarter. That's an almost doubling of bad loans. Does it get much worse from here on, Sanjiv?
Hopefully not. As long as the pandemic does not throw up any nasty surprises, I would expect the worst to be behind us. As a company, we are very driven by the numbers that we see, and that's why we are very transparent in sharing those numbers so that our investors can make their own calls. But as of now, things are looking better than what we had expected. We were very conservative early on. We cut growth. We upped our collection efforts. We gave moratoriums to customers that wanted it. The good thing that we are seeing is that other than a small segment of customers who went through a tough period, and they are the ones that are contributing to the higher losses, but many others have started coming back and paying. And new loans that we have given, so the book that didn't exist prior to COVID, that book is operating at the same quality level as the pre-COVID book, which means inherently we are still in a country where people want to pay, they are honest. Some of them have gone through a terrible time, and we are part of the system that will have to absorb some of those losses. Like the government is taking some, the individual is taking some, the financial services system has to take the rest. But incrementally, as of now, things are looking better.
So you're peaking out at 2.83 or 3% or so, nothing beyond that?
That's what it looks like as of now.